If you had a quiet spring, a slow start to summer, and then one client dropped a five-figure invoice on you in August, the IRS still thinks you owed them equal money back in April. And unless you push back on paper, they'll charge you interest on cash you literally hadn't earned yet. That interest rate just jumped. Per Revenue Ruling 2026-10, published in Internal Revenue Bulletin 2026-22 back in May, the underpayment rate for individuals is 7% for Q3 of 2026, up from 6% in Q2. Every week you wait past September 15th to fix this is another week of 7% annualized interest, compounding daily, on a shortfall the IRS invented by assuming your income arrived in 4 neat pieces. It didn't. So here's the question worth 20 minutes of your evening. How do you tell the IRS, legally, that your March self and your August self are not the same freelancer? The tool is Form 2210 and specifically Schedule AI, the Annualized Income Installment Method. And honestly, this is the single most underused form in freelance tax because most CPAs won't run it unless you specifically ask, since it's tedious and the fee to prepare it usually eats the penalty savings on small shortfalls. But if your Q3 spike is real, I'm talking a 5-figure jump versus what Q1 and Q2 looked like. You're leaving actual money on the table. Let me back up and explain what the IRS is actually doing when it charges you an underpayment penalty. Because once you see the mechanics, Schedule AI stops feeling like magic and starts feeling like arithmetic. The default rule under IRC Section 6654 is that you owe estimated tax in 4 installments. April 15th, June 15th, September 15th, and January 15th of the following year. The IRS assumes, with no evidence mind you, that you earned exactly 1/4 of your annual income in each of those windows. So if your total 2026 tax bill ends up being $40,000, the IRS retroactively decides you should have paid $10,000 by April 15th, another $10,000 by June 15th, and so on. If you paid less than that by any given date, they charge interest on the gap from that date until you make it up, at the quarterly published rate. Per the 2025 Form 2210 instructions, the penalty is calculated separately for each installment due date. Read that twice. Separately, which means, and this is the part that catches people, overpaying in Q4 does not erase a Q3 underpayment. I've watched freelancers write a giant January check thinking they've fixed everything, and then a CP14 shows up in April with penalty interest anyway. Later payments don't cure earlier gaps. Only Schedule AI can retroactively shrink what you were required to pay in an earlier window. Now, before we go further, there's a safe harbor most people lean on, and it's worth understanding why it isn't enough for the freelancer we're describing. Under Section 6654, you avoid the penalty if you pay the smaller of 90% of your current year tax or 100% of your prior year tax. That 100% rises to 110% if your 2024 AGI was over $150,000 or $75,000 if you're married filing separately. That's per the 2025 Form 2210 instructions, Part 1. Great rule. Real problem though, it still forces you to send 25% of last year's tax by April 15th, regardless of whether you've earned a dime yet. If 2025 was a monster year and 2026 started slow, Safe Harbor is a cash flow nightmare. Schedule AI is how you legally push the required installment to when the income actually landed. Here's how the mechanics work, and I promise the math is friendlier than the form looks. Schedule AI breaks the year into 4 cumulative periods: January through March, January through May, January through August, and the full January through December. For each period, you calculate your actual cumulative net income, then multiply by an annualization factor. Per the IRS instructions for Form 2210, Schedule AI. Those factors are 4, 2.4, 1.5, and 1. So the January through August period, which is what matters for our Q3 spike, uses a factor of 1.5. You take 8 months of income, multiply by 1.5, and that's your projected annual income if the rest of the year looked like the first 8 months. Then you compute the tax on that annualized amount as if it were your full year income, and apply the cumulative applicable percentage. Those are 22.5%, 45%, 67.5%, and 90% for the 4 columns. By September 15th, you're required to have paid 67.5% of that period's annualized tax, no more. Let me walk one all the way through so this stops being abstract. Say you're a single freelancer, and through August 31st, you've netted $30,000 of self-employment income. Slow spring, quiet summer. Annualize that at 1.5, and the IRS treats you as a $45,000 a year earner for that period. Federal income tax on $45,000 for a single filer, after the standard deduction and QBI, lands somewhere around $3,400. Then self-employment tax, that's 15.3% under the Social Security and Medicare split, with the Social Security portion capped at the $184,500 wage base for 2026 per the SSA fact sheet. Adds roughly $4,240 on that $30,000 of net earnings. So call your annualized combined tax around $7,640. Multiply by 67.5%, and your required cumulative payment by September 15th is about $5,157. If you'd already sent $2,000 in April and $2,000 in June, you'd only owe roughly $1,157 more by the 15th to be totally clean. Under the default equal installment method, the IRS would have wanted 75% of your full-year tax by September 15th based on what you eventually earn, which, if that big Q3 client pushes your year to $110,000 net, is a completely different, much bigger required number. Same total annual tax, radically different quarterly requirement. That's the whole game. A few operational things people trip on. First, and this one matters, if you use Schedule AI for any one payment due date, you have to use it for all 4. You can't cherry pick. That's straight from the Schedule AI instructions. Second, if you want the annualized method applied, you have to check Box C in Part 2 of Form 2210 and attach Schedule AI to your return. The IRS does not do this for you. They'll happily send you an equal installment penalty bill and let you eat it. Third, there's a related lever most people don't know exists, Box D. By default, federal withholding from a W-2 side job, or from voluntary withholding on 1099-R distributions if you took one, is treated as paid in equal amounts across the 4 due dates. But you can elect on Box D to treat it as paid when it was actually withheld. If your withholding was front-loaded, Box D helps. If it was back-loaded, say you took a Roth conversion in November with 24% withheld, Box D is your friend. One more edge case worth naming because it burned a friend of mine last year. Self-employment tax has to be annualized inside Schedule AI using Worksheet 2.3 from IRS publication 505. You can't just take 15.3% of your annualized number and call it done, because the Social Security portion caps at the wage base. For 2026, that base is $184,500, up from $176,100 in 2025 per the SSA COLA fact sheet. If you're a high-earning freelancer whose annualized August number would already blow past $184,500, Worksheet 2.3 correctly stops applying the 12.4% Social Security piece above the cap for the period. Skipping the worksheet is how people accidentally overstate their required installment and defeat the whole point of filing the schedule. Also worth flagging, Public Law 19921, the One Big Beautiful Bill Act signed July 4, 2025, added a new deduction and modified some rules that flow through Schedule AI Line 14 for the 2025 tax year. If you're amending a 2025 return or running Schedule AI for tax year 2025, use the updated 2025 instructions, not a prior version floating around in your tax software's cache. Small thing, real trap. I cover taxes and retirement for self-employed workers, and my honest take is this. If your Q3 income is more than about 40% of your annual income, run Schedule AI. If it's less, Safe Harbor is probably fine and the form isn't worth the Saturday afternoon. That threshold isn't in any IRS publication. It's just where, in practice, the penalty savings start to comfortably exceed the 2 hours it takes to fill the thing out. Your bracket, your filing status, whether your spouse has W-2 withholding, whether you had a Roth conversion, all of that shifts the math. Run the numbers for your situation before you decide. One belief I want to kill on the way out. No, overpaying in January doesn't retroactively fix a September underpayment. I keep seeing this in freelancer forums and it's just wrong. The penalty is per period. Only Schedule AI or the Box D withholding election can move required dollars backward in time on your behalf. Everything else is the IRS smiling and cashing your interest check. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this saved you a penalty, or better, if it saved you from sending the IRS a check you didn't actually owe yet, hit subscribe. It's how the channel keeps going. If there's a specific freelance tax or retirement question you want me to unpack next, drop it in the comments and I'll pull it into an upcoming video. Next week, I'm tackling a big one. When your joint income is over the Roth IRA limit, is the backdoor Roth actually worth the paperwork for a self-employed person? Or is a solo 401k Roth the smarter play? See you then.